Welcome to another episode of the Wealth Building Strategies podcast. I'm your host, Jeremy Constantino, and today I'm joined with Sief Khafagi. Welcome, Sief.
Hey, Jeremy, thanks for having me. Great to finally meet up in person here this past week.
That's right. So, for those of you that don't know Sief is the CEO of Techvestor. And in the last year, he has made tremendous gains in the Airbnb, VRBO, short-term rental asset class and has purchased over 75 properties in over 10 markets, $36 million fund, 250 investors. So congratulations to your success last year, Steve.
Thanks so much, Jeremy. Yeah, it's been a rocket ship of a year, especially with everything going on in the world. It's been fun to navigate that, but also prove a lot of the potential fears of the space wrong. And as we've kind of scaled, so we're really excited to continue doing that as we continue to grow.
Yeah, and so that's what I want to talk about in this podcast is our listeners in the podcast are accustomed to hearing our past episodes talking about commercial real estate. And so now we're going to be talking about Airbnbs. And so the question is, well, is Airbnb, what's Airbnbs and VRBOs? That's residential. So why are we including residential in this conversation of commercial real estate? And is it really a commercial real estate asset class? Um, so let's talk about that in this podcast. But I guess let's get to know Sief and let's talk about your background in real estate, where you're coming from, so our listeners can get to know you.
Yeah, so for me, I was a young kid growing up. First generation to go to college. Joined a state school after going through community college and worked my way through kind of that traditional cultural story of, hey, go be a doctor, go be a lawyer. And I was like, no, I want to go play with computers. And that wasn't, the best look at the time in my family, but hopefully today they're looking at me great, and I know they are. But I was at school, San Diego State, and I was recruited by a hedge fund recruiting agency to come build out their recruiting firm. I was there for about 30 days, realized I hated it in many ways. And then went back to starting my own company, which was helping people get into kind of big tech, Facebook's, Apple's of the world. And from there, Facebook called and was like, hey, bring in your work to do good instead of helping people beat our interview on the outside. Right. And I was a young kid, never saw money like that in my life. Great opportunity, moved from San Diego up to San Francisco, a really fantastic opportunity. And over the next 5 years, I'd lead teams all across the world and building our second largest engineering organization to build from a few hundred people to a few thousand people. And really that's where I learned about infrastructure operations, and not just tools and things, but most importantly, people and how you navigate and build infrastructure and systems around humans. And those are typically kind of like big deals in the Airbnb space. So when I was there, I learned a little bit more about real estate because it's a young dude making enough money when California and taxes hit. And you're like, how can I get some of those nice little tax breaks that I'm sure you talk about quite a bit? And so I started dabbling in real estate myself. Sabrina's my co-founder. We're both ex-Techie, she's ex-Apple, and we got to know each other over the pandemic for a little bit. And we just really got enamored by the STR asset class. She had owned a few. And we're like, how do we scale this, right? I know we're going to talk a little bit about that today, but we've done a really great job of figuring that part out and using technology and talent in navigating that world. So really lucky to be here. Definitely privileged. Right time, right place. But most importantly, I have a fantastic team behind us.
So I guess what did you initially So what did you do initially first in real estate? Did you go ahead and buy a residential home and turn it into a short-term rental?
Yeah, so the first thing that I did actually was a buddy of mine and his family were losing their house, and I actually offered to buy it, and I was like, I'll buy it, and then you can just rent it back, right? And if down the line you want to buy it back, then we'll just figure it out, kind of go from there. And that was kind of my first experience of a tenant. But my first experience really in the STR space is going back to my Facebook days. opening up offices and launching new teams and doing all those things over 5 years all across the world, I stayed in a bunch of shitty Airbnbs, right? When you travel and open up a new office, it's not like a 2 day thing, right? Where you're there, right? You're talking about like plotting down, right? You're there maybe for 4 weeks at a time, right? And you're like, okay, what do the vendors look like? What does transportation look like? What does food look like? What does labor look like? Like, what are the nearby schools? What does housing look like? What, all of these types of things of infrastructure, because you're building a mini company, right? All over again in this new physical space. And, we stayed in a bunch of Airbnbs, and every time I opened up the door to one of these Airbnbs, I just didn't even want to go in, right? It was poorly designed, poorly managed, things that broke, no one got back to you. And as I learned more about the space and how much people were making, how much we were paying, I was like, wow, someone should really fix this, right? And for us, Sabrina, again, coming from Facebook and Apple, we're kind of conditioned. Again, if you were to ever walk on Facebook's campus, you would see that everything is tech enabled, right? Like ordering food, it's just incredibly high tech. And for us, we're like, how do we bring that approach to single family residential, specifically in the STR space, and compete against mom and pops where we are the Facebooks and Googles of the world, right? How do we go in and really institutionalize this asset class? And you brought up a great point earlier: is this considered a commercial asset class? In my opinion, it is, right? Because we're buying mispriced real estate, right, as single family homes, essentially doing a query development into a short-term rental, which is a business asset, not a residential asset, comping it based on revenue and driving 3-4x the revenue as an LTR, and therefore it's valued significantly more. And who's doing this? Nobody. No one's doing it at scale, right? So for us, our competition barrier is extremely low.
Yeah, absolutely. Anecdotally, my experience with Airbnbs is a story really with my wife. I worked as an engineer with Chevron for many years, and my wife and we lived overseas in Venezuela. So when we would come back to the United States, and we have a daughter, we would need to find places to stay, and the hotels just doesn't accommodate a family life. So as over the last 10 years, we now have 5 kids. Anytime we travel, we have to stay at an Airbnb or VRBO because we'll be paying significantly more at the hotel and having 2-3 rooms, and that just doesn't make sense for a big group. So over these last 10 years, we've loved staying in these short-term rentals because it makes sense for a big group like us.
Yeah, it's super economical, right? Like we focus on 4 bedrooms and larger with amenities, right? Our average group size is 7 to 12 people, usually in that range. And one thing that I talk about is I have 2 young kids as well, right? 2 under 2. And, first of all, when they're older, I can't wait for them to have their own room, right? When you travel, but naturally, you want places for them to play, for them to run around, for them
Right.
to crawl around, a
Right.
kitchen, those types of things. But, also this physical barrier of a hotel room, right? If you have 12 people, what happens after dinner? You all go to your room.
Right.
It's the only option. It's that, right? Or you're staying somewhere downstairs at the hotel or somewhere around or wherever you're going. In an Airbnb, the fun doesn't stop,
Right.
right? Those memories don't stop. There is no physical barrier to that
Right.
experience, and therefore we're in a space of experiential living. Also, we're in a time where people crave that more than anything after the pandemic, right? There's a saying, which is to invest where the puck is going, not where it's been, and that's really what we believe in.
Okay, let's talk about now transitioning to saying, Sabrina, we got this idea. Let's go ahead and buy 75 homes. Like, how did that come up? And how'd you say, oh, we're going to get $36 million and we're just going to do this?
Yeah, I wish I could lie to you and tell you that that's what we talked about in terms of how it happening, but it went more along the lines of, I remember the day we got together and we whiteboarded what we believed our company would look like in scaling Airbnbs. And the short story was we were like, let's go buy 5, 5 to 8, right? And help people get into the Airbnb space. In fact, our first product that we did is we helped people buy their own Airbnb. That was our first 6, 7, 8 kind of properties we bought. And we found friends, family, colleagues, each put in $250,000 with a high barrier to entry. We did all the work, split the profits with them. And we got them all in a Zoom together, kind of just like almost like please give us feedback. And the look on everyone's faces of, pointing to someone else's property and being like, wow, that looks cool. Wow, I wish I could have a piece of that one. They were all basically saying, I want a piece of someone else's, and explaining what a syndication was
Yeah.
without explaining what a syndication was. Right. And so, 2 days after that call, I get them all back on Zoom and I'm like, what if we all brought this in together and launched a fund, right? Because instead of you owning a single expenditure or a single asset, right, all of you would contribute your pro rata share, and all of us would be owners of this entire portfolio, and then we'll grow the portfolio rather than grow the single assets. We'll continue to do everything for you. And then I would go ahead and then release this to a couple more friends. We actually went viral in a Discord, fun fact, in the tech community. And in 30 days later, we raised our first $7 million,
Wow.
right? From people who had really understood and wanted and felt the pain of what we were talking about. Because now the minimum was 25 grand, not 250. Right. The level of effort and work was just write a check, not do anything else. Right. I went from you needed to qualify for a loan to you didn't need to do anything. Right. And so we built an experience for investors. And our first project, our first property in the fund, we would officially go live with in January, which is a couple months after that. And then from January to end of 2022, each quarter we start to raise a little bit more money because people start to, come around and they're like, wow, this is great. Like, you start to almost prove, as the saying goes, prove the haters wrong, right? Like you can actually scale this. And then in Q4, we had our largest round ever. And that's how we landed a little bit over today, actually over 37 million. And it's one of those things where I can sit here and tell you that we planned for it, but we didn't, right? We adapted along the way. We built technology. We hired the best possible people. I'm a huge proponent of hire the best absolute talent. In fact, if you hear me on any other podcast, it's a consistent thing that I always talk about is we will always have the best team. And because we have the best team, we will always figure it out, no matter what happens. In real estate, if anyone's been in real estate long enough, I had a chance to talk to John Turley over at RaceFest for quite a while we were there. And man, he had some stories he was telling me. And it's a man who's been in real estate for about 30, 40, 50 years. And, 95% of real estate is the ability to figure it out, right? As things come up. And so we want to be able to have that strength every day.
It's awesome. Yeah. For the listeners out there that don't know, I personally invested passively into Sief, into your fund, into fund one, or in a part. So I have a little portion of those 75 properties. And so for me, somebody that's been investing passively and actively in real estate since 2005, I've seen a lot of deals out there and a lot of opportunities. And I think I made the decision to invest in this fund within a matter of seconds. So I didn't know about the fund, and through other person and Raise Masters, the mastermind that the opportunity came up, and it was short-term rentals that piqued my interest. Diversified across 10 markets, 75 different properties. We have a whole team set up, and we've got proven track record, and we've got these great returns already over 2022. And I just said, okay, where do I send the money? It was just like it checked all the boxes. There's no downside. It's diversification. It's an emerging class, and you guys are doing something that is not being done in this asset class. There is no institutional players. There's no big companies efficiently with a great operating system to manage a portfolio of properties. So I saw that, I said, this is where my passive investment needs to be. And I wired the money. And it's just like, it literally was a matter of seconds. I was like, investing. And then also to disclose to everybody that's listening as well, I've decided, or Sief, thank you for inviting me. I've decided to be a fund manager now for the fund two. So I guess, now let's switch over to fund two. And what are your plans for 2023?
Yeah, first of all, thank you for taking the chance on us young and early. And I think hopefully one thing that we can both agree on is the investor experience is so important. So hopefully all your investors, Jeremy, get that same feeling when they're reading through, and most importantly, feel educated on the decision and have that similar conviction. But in fund two, really what we're doing is bigger, better, more scale,
Love
right?
it.
And what's really awesome, and I think something that is such a forgotten thing as we enter fund two, and I very first thing I say when someone says, why should I invest in your second fund? My first thing I say is, we have everything right that we've done in fund one that we're starting fund two with.
It's awesome.
Right? We're entering fund two knowing what 10 markets plus we can go enter and buy our first 75 or 100 properties. We already have our own first person level data as to what works in those markets and what doesn't. We've already made mistakes that we won't make again in fund two, right? Our team today is over 30 people of full-timers, contractors,
Wow.
and people that we work with. And our team today is significantly stronger than when we started fund one. Our head of asset management comes from Vicasso, ran portfolios and data there. We have a head of data today that we didn't have to start fund one. Our head of operations, Josh, comes from DR Horton, right, where he scaled up to $350 million in single families, right? Like these advantages, the technology that we'll do a demo here in a little bit. None of that was built on day one of fund one. And so, here we're looking at, 75, $100 million, $150 million fund, hopefully here in fund two with support from people like yourself and a lot of other great partners. So we're excited. And we're really excited to continue delivering returns for investors, and coming hot off the press here, Q4 metrics, it looks really promising to where we're heading.
Awesome. Congrats. I guess so. Let's finish this podcast episode talking kind of how we started out. I started out saying that, is commercial real estate, is STRs part of commercial real estate? And obviously we say yes, it is. So I guess from a passive investor perspective, that's the majority of our listeners on this podcast. So from a passive investor point of view, talk about the advantages and disadvantages of comparing short-term rentals with maybe multifamily, or I guess we'll start with that. So I guess talk about what's the difference from a passive investor standpoint. What are some of the risks or benefits of going short-term rental versus multifamily?
Yeah, first and foremost, I'm a huge proponent of multifamily and a huge advocate of it. Each year I'm an investor in multifamily and self-storage and mobile home parks. I believe a well-diversified approach is the best approach as well. And, multifamily is the king of the game, right? It's one that's been around the longest, has an established track record. All the big players play in it. It's traded well, right? It's understood in that space. All of those advantages are also the advantages on the other end of short-term rentals, because they're misunderstood, right? No one is scaling it. No one can scale it, and your institutional competition doesn't exist because BlackRock, Blackstone, these large players, they have no interest in dropping $500,000 at a time to find, design, furnish, run, operate, and stabilize a short-term rental. What they will do is buy the portfolio of a stabilized portfolio because it's got yield in place. So for us, we believe single-family homes, which by the way is one of the fastest growing residential or just real estate asset classes in the institutional space, right? And we're a niche within that, right, of short-term rentals. And what we believe is that they're mispriced assets. And why do we believe they're mispriced assets? So if you look at multifamily, we all can agree that you can value add and do development and ground up and all that. In residential, when you take an LTR to a short-term rental or a long-term rental to a short-term rental, you're not doing physical development. All you're doing is operating it differently and juicing the yields. You're getting the benefits of development, the yields, the returns of development without the risks of actual development, right? And so those are really fantastic. Not to mention that when you talk about the level of competition, this is one of the biggest things we stress to our investors is go on Airbnb, any market of your choosing, okay? Compare the design, the quality, the pricing, the approach. And I can assure you that 95% of the time, we will outperform the average operator in the space. In fact, coming off of Q4, we did 72% more revenue than the average homeowner that owns an Airbnb,
Wow.
the type of home that we own in the markets that we're in.
Wow.
Right. And so how do we do that? It's not rocket science. It's better design. It's not taking photos on your iPhone with an iPhone 4 camera and, you know, putting up on it. I'm serious. Like, this is a thing. Like, oh, I think that someone, I forgot which company did a study. It was like 46% of photos on Airbnb are taken by, I think, iPhone 4, iPhone 6 or earlier. And I'm like, there's this thing called megapixels, right? Just beautiful HD 4K photography, right? People eat with their eyes first, right? Great design, great photography. What about pricing, right? Fun fact, I did a test with my team, and we're going to Scottsdale for the Super Bowl. Just kind of hang out and have a good time. We own a bunch of property in Scottsdale, and we use what's called dynamic pricing. Dynamic pricing is you don't price a Monday the same as a Friday night. You also don't price the Super Bowl the same as a random Tuesday night, right? Now, most homeowners, in fact, a lot of homeowners don't do this. They price every night $300 a night, as an example.
Correct.
Right?
Correct.
So what we did is I went and found a homeowner, it's a beautiful home, charging a flat, I think it was $400 a night in Scottsdale during the Super Bowl, Jeremy. Okay, during the Super Bowl. I booked it. I'm gonna have a great time. All right, I'm gonna have a great time. Now, in the meantime, right, my capitalistic approach is our Airbnbs are getting anywhere from $2,000, $3,000, or $4,000 a night for the same exact night. Why? Because of dynamic pricing, right? And so, if you're familiar with multifamily, when you know the story of push rents up, right? We're doing the same thing, right? By pushing rents up, and when you push rents up, and you push revenue up, and you push NOI up, that property is worth more, that portfolio is worth more. And the ability for us to aggregate these properties together in a single asset or a single sale to a large buyer, there's no one else doing it. Now, will there be a buyer for it? I can tell you we've already received at least 2 letters of intent, right? Who people want to buy the stabilized portfolio, because you can't go buy this asset. Where are you going to go buy it? You need someone like us to go do the grunt work, right? These large players, right? So that's what they're depending on. And our worst case is we hold a really great high cash flowing asset for 5 to 10 years, great yield. It's conservatively sold based on value, which is how single families have always been sold for the last hundreds and hundreds of years. And we generate a 10 to 14 IRR. That's our down case, assuming the world doesn't crater, right? And if the world craters, then, well, everything's relative at that point. So we're excited about where we're going with fund too there.
Yeah, I love it. I love the concept of selling these residential homes based on a cap rate, not based on comps. So it's
very straightforward.
Yeah. Yeah, and then for me, what makes so much sense for multifamily, the reason why it's so attractive to investors, it's a physical place to live. People always need places to live, and multifamily is there's multiple spaces, so that if you have a couple vacancies, your whole investment doesn't dry up on cash flow. It's the same concept with Fund 1 and Fund 2. We have multiple properties, so if one or two has struggles and doesn't have has a lot of vacancy, the entire fund doesn't struggle. And then 2, we're providing people places to live. So yeah, it's hospitality, but still, people still need places to go short term. So I love it, Sief. I'm glad to partner with you on Fund 2, and I'm glad I invested in Fund 1. Any final words to passive investors on this podcast?
You get to use the homes. So this is probably the only investment you'll have that has utility. If you ever do use the homes, we invite you, your friends, family, and everyone to kind of go enjoy these assets. It doesn't affect the investment because you're getting it at a discount that's on par with what we would give online anyway. And it's a really fantastic time to get into the headwinds of things before things actually shake out, in my opinion. I think 10 years from now, my hope is that this is a true identifiable asset class, and we have a lot of great options in terms of exit, how we're mitigating risk. But you're betting on this team, and we have an incredible one, right? Can't stress that enough. And the people here, Jeremy included, are fantastic human beings in terms of getting shit done. So we hope to have you.
Awesome. Well, thank you so much for your time, Sief, and definitely have you on a podcast as a guest later on in the year and talk about how we're crushing in a phase on Fund 2 and see what your plans are for Fund 3, 4, 5. Who knows what's in store after this. But Sief, it was a pleasure. And for the listeners out there, in the show notes, I'll leave links on how to get in contact with Sief and myself. And if you want to invest in this awesome emerging asset class, we'll leave links so you could very efficiently invest and go through the investor portals with us. So yeah, thanks, Sief, and thank you, listeners, for this latest episode of the Wealth Building Strategies podcast.